Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. Canada's economy, we saw the annual inflation rate falling 2.3%. This is for the month of March. It was from 2.6%. That was in February. So we did see that. And while this drop offers a moment of perhaps relief for consumers and policymakers alike, it comes at a time when global markets grapple with really mixed economic signals. With the US seeing an exodus of investment, Canada's market performance continues to stand out, outperforming its peers. What are some of the benefits to investing in Canada today? And which super sectors is our next guest closely watching? Happy today to be joined by Fidelity Director of Research and Portfolio Manager, Reetu Kumra, for a look at a position in the Canadian Long-Short Alternative Fund that may benefit you and or your clients. Welcome, Reetu. Great to see you.
It's great to see you as well. Thank you for having me.
Great to have you back here and to take us through things at this very interesting juncture and moment. Reetu, why don't we begin with some thoughts on this wild market that we're all sitting amidst? We did get inflation in, so why don't we begin there?
Okay, sure. So yes, as you mentioned earlier, we did get a cooling on the headline number from an inflation standpoint. However, core still stands in and around 3%, and it was pretty much even month over month. This number that we saw this morning was clean of the GST holiday, and so it really tells you where we are with the here and now. So what drove the lower headline number? Gasoline, travel, all of that kind of came down. But you know what? This morning it was a little bit of a non-event because the focus is not what happened last month, but what's going to happen on a forward-looking basis. And what's front and center right now are the tariffs.
Yeah, I mean, we used to watch CPI and any sort of inflation data so closely, but it is a bit of a non-event, isn't it?
It is, yeah.
What about for rates?
Well, rates are pretty much flat today. And so, again, just...
We've got a Bank of Canada decision coming up. I mean, does this number take us in one direction or the other particularly?
So again, I think the focus will be the core print. And so I think it's a little bit of a tricky situation. And so we've already cut a number of times. The Bank of Canada or the market is expecting another 2 cuts by the end of the year. So let's see what happens tomorrow and what the Bank of Canada decides, because there's a lot of risk in the market and uncertainty in the market. And let's see what happens in terms of what they weigh as being more important.
Markets largely have been reacting to tariffs and the announcements and non-announcements and rollbacks and progress. There have been moments of whipsaw, but we are seeing a bid back in for sure at this point. What would you like to say to investors about what they're watching in markets right now? Because everyone's sort of been looking for a place to hide or gain in the last little while.
No, absolutely. I think in order to understand what's happening today, I think we need to take a step back and understand where we've been. So if we look at, if we rewind the clock 2 years, we look at what happened in 2023. We had a year of multiple expansion, but not much in the way of earnings growth. And in 2024, we had both. In fact, it was a fantastic year for market returns. And so we have to appreciate where we've been. The S&P 500 was over 20%. The TSX was just shy of that. And that's because we had 2/3 of that return being multiple expansion and 1/3 being earnings. And so as we walked into 2025, the markets were basically at top decile valuations. And so we've talked about this in the past where it was priced to perfection, particularly after the election late last year, where after President Trump was elected, the narrative became about US exceptionalism, US dollar dominance, crypto, tax cuts, deregulation. And so there was a little bit towards the end. And there was a little bit of a euphoria in the market. And so as we walked into this year, the market was, the S&P 500 was at 22 times earnings for low double-digit growth. The TSX was at 16 times earnings for high single-digit growth, which was very elevated relative to what we've seen in the past. The tariffs have changed that. And so since the beginning of the year, we have seen quite a bit of multiple compression. So where we stand today is the TSX is roughly 14 times earnings for high single-digit growth. And that compares to a long-term average of 12 times. The S&P 500 is 18 times earnings for high single-digit growth relative to a long-term average of 16 times. And the concern is that there's a lot of uncertainty in the market. I'm sure you've heard many members of our team talk about the fact that the market can handle good news, the market can handle bad news, but the market does not like uncertainty. And those are the times that we're in. So at this point, it feels like we are late in the cycle. We could
Does it? I mean, if you should sort of pick a cyclical story, like does it feel like we're in late cyclical?
Yeah, I would say so, in my opinion. And whether this turns into an economic downturn or even a recession will be very much dependent on how the tariff situation evolves, as well as the duration. The market at the moment is a scenario that's being baked in by the market is stagflation, and so that could be something that we end up seeing. So I think what's important to keep in mind in this context, though, is that we've had a tremendous amount of volatility, and with volatility, we have opportunity. We have the opportunity right now to buy incredible businesses for cheaper valuations than we've seen in the past few years. And so our team is taking advantage of that, and the research team is doing an absolutely incredible job just trying to make sure the funds across the platform are positioned the way they should be positioned and understanding what our risk reward is right now.
So let's talk more about research, but specifically how it kind of fuels the fund that you manage ultimately, because it does come down to that, doesn't it?
Absolutely. So I can't talk enough about my research team. The research team here in Canada, there are typically about 9 individuals on this team. They are phenomenal at what they do. They've gone through our grueling interview process where they've met every single team on every single member of the investment team through a set of interviews, as well as doing a stock pitch at the end for the entire team. And they just have this fire to generate alpha for our fund holders. Like case in point is what has transpired over the last few months. So these tariffs were first announced at 7 p.m. on November 25th. Every single investment team member, or research team member, had a complete analysis in terms of exposures to each and every one of their companies, understanding what the valuation looks like, understanding where we should step in, what the risk reward looks like, understanding the drivers before market open the next day, which is absolutely incredible. And it's really talks about the power of our research team. So as a result, this team is in the trenches. They know exactly where the assets are, where the sales are, where the exposures are, who the competitors are. And so they're focused on the stock drivers, valuation, dissecting balance sheets, and really just they've done an incredible amount of scenario analysis so that when we had the beginning of February happen, where there was a potential for tariffs, and then again the beginning of March, and then eventually Liberation Day, as news flow has evolved, they have been doing such a great job in equipping the entire team and our products in terms of where we should be positioned.
It must be such a live document each for each company because it's constantly being changed and added to when you hear more about autos or less about autos and so on.
Absolutely.
Tell us a little bit about how you have put that research to work within this fund. It's a long-short fund. Tell us, and it focuses on Canada, which I think to a lot of people, we've all thought we need to be invested in Canada, but maybe somewhere else, maybe the US as well. Give us sort of the pitch for Canada right now.
Sure, absolutely. So it's interesting because the narrative around Canada has not been positive. And so if we think about what we have heard in the past, okay, so we have a lot of leverage within the consumer base. So if you think about what happened during the GFC, the U.S. consumer delevered, but the Canadians just kept going up in terms of leverage.
Buying more expensive houses.
Exactly, exactly. And then marry that with the fact that we have higher interest rates than what we've seen in the past, and we have a wall of mortgage maturities coming up this year and next. And so that doesn't sound very good. And then you tack on the tariffs that have emerged as well as election risk, and the top-down narrative does not sound good, and not to mention productivity as well, the lack of productivity relative to our friends south of the border. So while that all is very true, I think what's important is to understand Canada from a bottom-up standpoint, as well as to understand the TSX from a bottom-up standpoint. So when you look at the mix of the TSX, we have roughly 40% that are interest rate sensitives, which typically, in general terms, do well within when we have a monetary easing cycle. You have about 30% that are resources. Within that 30%, there's a 10% slice that's gold, and we all know that gold has been doing quite well. The rest of it being industrial commodities as well as energy. And then you have the rest, the remaining 30% that is very much consumer and industrial businesses, where if I had to put them in broad categories, you have your cyclicals like your transports and autos. You have your quality compounders like grocers and C-stores. And then you have your defensive category, which is like, you know, waste names as well. So I used to cover, for example, I used to cover the C-stores when I was an analyst, and that was back in 2012. Couche chart at that point was a $5 billion market cap.
It's massive.
Now it's, and it was primarily Canada, a little bit of US. Now it is a $70 billion market cap, and it's global, and it's
all
going
over Europe, maybe Japan.
Yeah, maybe Japan, exactly, maybe Japan. And so those are the types of businesses that we have that are more global in nature. Of course, in today's market, we're very much focused on the impact given the geopolitics around the world, but we have really good businesses in that third category. So it's not surprising when I kind of lay it out in that sense that the TSX is outperforming the S&P 500. And that's exactly what this fund is trying to capitalize on. The opportunities, regardless of what the top-down narrative is, the opportunities both on the long and the short side.
Okay, so on the short side, give us a little bit of an overview of sort of what's in there. I mean, one would imagine it's things getting very hit by tariffs, but give us more.
Yeah, so maybe what I'll do is I'll take a step back and talk about the overall positioning of the fund, because I think the long goes hand in hand with the short.
Okay.
And so,
so 130 to what is the mix?
Sure. So basically, the way to think about this fund is it's a core Canadian diversified 130-30 long-short product. And from a portfolio construction standpoint, we're very much focused on allowing our research to really determine what is in the fund. And so maybe if I take a step back and just describe the fund a little bit, and as well as the genesis of the fund, it might just help put this into context. And so this fund is really about the breadth and the depth of our research. And so the genesis of it was back in 2019, where we did a study where we were trying to understand with our internal data how the quality of our research. And so we have a tremendous amount of data with what our ratings are, as well as our rating changes. And so we just dissected it. And so what we found is we knew that we were good at identifying buy-rated names, but we found that we're actually even better at identifying sell-rated securities. And so if you recall the scissors chart that we often use, this fund is trying to capitalize on not only the top side of the scissors chart, but also the bottom side of the scissors chart. We also found that our ratings are very accurate and actually very consistent over time. And so the thought was to create a fund where we take our Canadian research and we go long on our buy-rated names and we go short on our sell-rated names. And from a portfolio construction standpoint, we're just trying to manage the risk and return through the cycle. A little bit of a lesser known fact about this fund is actually it tilts small cap with the way the fund is constructed. And so the average market cap of the fund is 10 billion, and that's relative to the TSX at 45 billion. So it really goes into an arguably less efficient part of the market. So the way I describe this fund overall is
it's fascinating that it goes into a less efficient part of the market, and that you have consistent calls.
Exactly. Yeah. Exactly. And so it's just a core Canadian fund. It offers alignment to the TSX. We go long on our buy-rated names, go short on our sell-rated names to really capture that broader alpha being generated from our research and just that consistency and accuracy of our research that's behind this product.
So just whatever you can give us in terms of positioning without going into too much detail, but just to kind of give us a snapshot.
Sure. So the fund is, at the moment, it's tilted more quality, more defensive.
Okay.
And so
that's good in this market, yes.
It was positioned well heading into the volatility that we've seen. And so, and that speaks to our research. And so typically, so again, it's a Canadian-only portfolio. And so we cover, here at Fidelity, we cover roughly 98% of the benchmark. And there's an expression, whether it's on the buy side or the sell side, of each and every security that we cover. with constraints and parameters around it. And so as a result, you have anywhere between 120 to 180 positions at any given time. Within that, you have between 40 and 80 that will be on the short side.
Okay.
And what we're focused on is the alpha being generated within the super sectors. So our super sectors are interest rate sensitives, resources, consumer, and industrials. And what we're really focused on is being neutral to the TSX, so getting that alignment to the market,
Okay.
being neutral to the TSX from a super sector standpoint, and having the research generate the alpha within the super sectors.
Okay, got it.
So in broad strokes, from a positioning standpoint, I mentioned that it tilts lower beta at the moment. And so, if speaking about the interest rate sensitives, right now, it's, as per last disclosure, it is overweight utilities at the expense of financials. Okay. Within financials, underweight the banks. We like the PNC names. Right. We like select diversified financials, but again, that's at the expense of the banks. REITs are more neutral and very selective within the telcos, given the dynamics that we're seeing in that space from a competitive pressure standpoint.
For sure. That's so interesting. So, okay, carry on.
So then from a resources standpoint, overweight gold. We like gold, and that's at the expense of some of the more industrial commodities. Okay. Neutral on energy, but the focus is primarily on the higher quality energy names, so midstream, pipelines, right. Royalties, over the higher beta ones, just given our view on energy at the moment. And then within the other, the category where it's the stock picking category, like the consumer stocks as well as the industrial stocks. It's very much within the three categories I mentioned: early cyclicals, quality compounders, and the defensive names. It tilts towards the latter two. Quality and defense.
And defense.
Yeah.
Okay. How is the consumer in Canada? I mean, you were speaking about the deleveraging that actually we haven't really gone through at this stage, and so it speaks to how the economy has powered through even amidst this. But how do you feel the consumer is? Sentiment has not been very good on either side of the border.
So consumer confidence is not great. We're seeing the unemployment rate tick up. And we talked about the wall of maturities coming up. Right. And so, I would classify the consumer as fragile. And yeah. So, it's interesting that, we have this dynamic happening, yet from a bottom-up standpoint, we're seeing quite a few names in the way of consumer stocks outperforming. And so again, it speaks to just the research, and really there's a top-down narrative, but then we focus on the bottom-up.
Staples, consumer staples, yeah. Doing well. Yeah, not discretionary so much.
Yeah,
exactly. Tell us a little bit about the dollar, the Canadian dollar, just mostly as it fits into what you're doing within your world and with your universe. The Canadian dollar, strangely, has kind of held up, and actually in recent days I think a lot of people might be a little bit surprised how well it's held up, because it's been quite a story circulating. How does this play into your decision making ultimately, where the Canadian dollar sits?
Well, so I can speak about the Canadian dollar, and then I'll speak about kind of how we think about it from the perspective of the fund. I think the Canadian dollar, when the tariff discussion first emerged, where it was very much a focus on Canada, the concern is what would happen to the weakening currency. And so we saw it go up to, I think, 148, and now we've kind of seen it come down about 10 cents. And so I think that's a couple of reasons. One, on a relative basis, Canada has at this point become kind of less of a target within the tariff discussion. Right. And so we'll see how that emerges over the coming weeks, especially after the election. And then the other piece is there is a theme out there of de-dollarization. And so you've seen a weakening of the US dollar as a result. And so where those dollars go, it's hard to say. It's commodities, other FX, other markets. Hard to say where those US dollars are going, but I think that's kind of how to frame that thinking. With respect to this fund, we're very cognizant of where our US dollar exposure is. And as I mentioned earlier, we have done so much in the way of scenario analysis, and this is just part of it. Okay, so what happens if the US dollar strengthens relative to the CAD, or vice versa? And so the analysts are very focused on running these scenarios.
Is it too late for the Canadian long-short alt fund for our clients? It's had a very good start / recovery. Yeah, the timing of taking a look at this fund.
I think the way to think about this fund.
You're not going to say it's a terrible time. Yeah.
I think the way to think about this fund is it's very difficult to time the market. And I think the way to think about this fund is it's just a core Canadian holding where we can take advantage of opportunities through the depth of our research, both on the long and the short side. So we're very much equipped for any market that we see.
Another question. I know the fund is young, but is there a target beta for the fund?
Well, I can't say there's a target beta. I can speak relative to history. In terms of the volatility of the fund, it's very much mirrors the TSX. And typically it's just shy of, when we back tested the data, it's just shy of one.
Of one, okay, really interesting. When you take a look, oh yeah, we were gonna ask you about this. Your research, the research that the team does, a lot of it will be, I mean, speaking to industry leaders, CEOs, industry leaders, summits as well. I think just wanted to kind of get a sense from you what you were hearing from the many avenues that you have into reading what company leaders are hoping to do, planning to do. Last week we thought we were going to get no guidance at all this earnings season. What are you learning?
So we just had an energy conference last week. We had an industrials conference a couple of weeks ago. And I think the broad theme that's coming out is, it's interesting because even 2 weeks ago feels like a lifetime ago.
It does,
and so
it changes so quickly.
Everything's just changing so quickly. So I think the broad theme that's coming out is uncertainty. Okay. And so it's very difficult for CEOs to make investment decisions at the moment when they don't know what the guardrails are. And so there's a little bit of a pause and just a wait and see moment at the moment when we speak to the CEOs, because we don't know what's going to emerge, both from an election standpoint as well as future tariffs.
Yeah, we don't want to talk about the election, but the election's happening. Is there anything that you and the companies that you follow that would be, I guess, on the long side of the portfolio that would benefit from the discussions around deregulation, also faster permitting from the resources and energy side of things? I mean, these are big things that would be quite material to companies if they shifted.
Yeah, absolutely. So it depends. You know, we have two key platforms that are in play, and so it depends on what happens and what transpires from the election. Okay. And so I think with this tariff discussion that we've seen over the last several months, what has come to the surface, and what's very prominent is the fact that Canada has or needs to diversify trading partners. And so whether that creates a CapEx cycle, it's to be seen, and that would be good for commodities. It would be good for select industrials, financials, and other sectors that I'm not thinking about right now. But I think what's key to more infrastructure is permitting and regulation. So there's a lot of if, ands, or buts, and so let's see. We'll see what happens with the election. We'll see what happens with the tariffs, and then we'll see what that medium term looks like.
That said, there must be three key scenarios you can give for us. So let's go out to the end of the year, assuming, I don't know, what do you assume? That maybe the tariff conversation is a little bit more visible, like we have some actual idea of where it's going. We'll have a government. How does the end of the year for Canada look versus right now? Is that something you can at least give us a 1, 2, 3 modeling that you're doing on?
Well, so these scenarios are being run by the analysts, but what I would say is to the extent that we get certainty, that's positive. Right. And so right now,
for what, the Canadian dollar,
it's depending on what that certainty is, right? And so it's hard to say what that ultimate outcome is, but certainty is positive for the market. And to the extent, and we'll see what magnitude that certainty comes in. Is it going to be a positive change or is it going to be a negative change? But irrespective of what happens, it'll be more certain than where we are today. Okay.
So nothing. You're not going to bite on that one. It's interesting. Let's talk about something that really is a fascinating diversifier that you've been following for some time. You run a fund on Bitcoin. Tell us about what the round trip that Bitcoin has been on over the last few months. It has a lot to do with the White House, really.
Yes.
I mean, almost entirely to do with the White House, its recent moves.
It's just been fascinating. And so maybe, again, to understand where we are today, I'll just take a step back and go back into history. So coming off of 2022, when we had rates going up and Bitcoin tested its lows for this cycle at least, We had a lot of froth come out of the system. We had some fraudulent cases, which we won't go into, but heading into 2023, actually towards the end of 2023, there's a little bit of rhetoric happening around a potential passing of the Bitcoin ETF. And so that ended up happening in 2024, which was extremely positive for the ecosystem, because it was just yet another avenue and almost a seal of approval from the SEC that we're willing to do this. 2024, we got the halving, where the actual supply got cut in half, which happens every 4 years. And then as last summer, my colleague Eddie Louie and I were at the Nashville Bitcoin conference, and we had President Trump show up at the conference, and he talked about having a strategic Bitcoin reserve. And so as it became more
closer to the election,
to the election, and became more evident that President Trump was going to win, Bitcoin just really took off. And so what we've seen since he's been elected is quite a bit. He's lived up to his promise. He has banned CDs. He has implemented a strategic Bitcoin reserve, like he had talked about,
which is central bank.
Digital currency. He has implemented the strategic Bitcoin reserve, but he talked about growing it on a dollar neutral basis. So let's see what that means. We have a crypto stockpile, so we have that as well. And we actually are closer to a stablecoin bill than we've ever been. So really there's the Genius Act, which was actually passed by the U.S. Senate Banking Committee, and is going to Congress now. And so you're seeing the deregulation that he's promised. You're seeing the strategic Bitcoin reserve that he's promised. And so this is very positive from a secular basis. But the market is currently toggling between focusing on the cyclicality of Bitcoin and whether it's a risk asset versus the positive secular moves. And so Bitcoin has been behaving like a risk asset, but interestingly, I was just taking a look this morning, Bitcoin's higher than where we were on Liberation Day. And so, and it's outperformed the NASDAQ and the S&P 500.
So where does it belong in what sort of allocation? Based on the fact that we can't quite tell if it is a risk asset in a secular market. Cyclical market.
I think it's an asset class in its infancy and is trying to mature and find its own path. And so right now it's toggling between a risk asset and focusing on the cyclical factors versus the secular factors. And so where it belongs, I've talked in the past about adding a 1 to 3% slice in a diversified portfolio, a 60-40, and just adding in that 1 to 3% slice to enhance risk-adjusted returns.
So with our final moment, so that's Bitcoin, which has been a fascinating journey. I was hoping you would talk about that a little bit. Just in our last minute or so, tell us where the fund itself, this is the long short, the Canadian long short, belongs. Where does it fit? Let's wrap up with that.
Absolutely. So I view the Fidelity Canadian Long Short Alternative Fund as just a core Canadian 130-30 long short fund. I view it as a returns enhancer, and it's a fund that really belongs as a core part of a portfolio. So again, just to kind of recap what this fund is about, it offers alignment to the market. It really allows our research, the strength and the depth and the breadth of our research to really come through, where we go long on our buy-rated names, go short on our sell-rated names, to really capture that consistency, that accuracy, and that repeatability of our research.
Fantastic. Reetu Kumra, it's a delight to see you as always. Thank you for updating us and bringing us something quite stable in a moment of a lot of volatility out there.
It's great to be here.
Great to see you.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.